If you are watching gold and silver right now, then this Sunday could be more important than it looks. The gold to silver ratio is hovering near the high 60s, and that number matters because it can reveal when silver is still undervalued compared with gold. Gold is trading around $4,400, while silver is around $66 per ounce. That puts the ratio close to 67 and keeps the market focused on the possibility of another major silver move. The bigger question is not simply whether gold and silver can rise. The bigger question is what happens if the forces pushing gold higher begin to flow into silver with greater intensity. That is where this story becomes extremely interesting. Gold has already shown extraordinary strength this year. Silver has also delivered a huge recovery from its lows. Yet the relationship between these two metals still tells us that the silver story may have much more room to develop. And if you own silver, then you need to understand what the ratio is actually telling you. The gold to silver ratio is simply the number of ounces of silver needed to equal the value of 1 ounce of gold. When the ratio rises, it means gold is outperforming silver. When the ratio falls, it means silver is outperforming gold. Right now, the ratio is sitting around the upper 60s based on current market prices. That is important because silver has already been extremely strong from its recent lows, yet the ratio has not collapsed to the levels that would suggest silver has completely caught up with gold. That creates an interesting setup. Gold is still attracting enormous attention because investors see it as a monetary asset. Central banks continue to accumulate gold. Investors are watching the Federal Reserve. The dollar remains a major variable. Geopolitical risk remains elevated. And bond markets are sending signals that investors cannot ignore. Silver sits directly in the middle of several of these forces. It has monetary demand, it has investment demand, and it has industrial demand. That combination makes silver different from gold. Gold can rise because investors want protection from currency risk. Gold can rise because central banks want to diversify reserves. Gold can rise because investors fear geopolitical instability. Silver can benefit from all of those forces, but silver can also benefit when global manufacturing expands. Silver is heavily used in electronics. It is used in solar technology. It is used in electrical systems. It is used in advanced industrial applications. That means silver can respond to both financial demand and physical demand. This is why the gold to silver ratio matters so much. Imagine a situation where gold continues to rise because investors are becoming more defensive. At the same time, imagine that industrial demand for silver remains strong. Now imagine investors begin moving more money into silver because they believe silver has lagged gold. That combination can create a powerful catch-up move. And this is the part of the story that many investors miss. Silver does not always move smoothly. Silver can spend weeks or months appearing to do very little. Then the market changes, momentum arrives, traders begin chasing the move, physical buyers become more aggressive, short positions are forced to cover. Investment demand increases. Suddenly, silver can move much faster than gold. That is why a ratio near 68 deserves attention. It does not guarantee that silver will rise. It does not guarantee that silver will reach a specific price, but it tells us that the relationship between the two metals is worth watching very closely. Now look at gold. Gold has recently pushed back toward the $4,400 area after a major recovery. On August 17th, gold was around $4,400 per ounce, while silver was around $65.82. Both metals gained as the dollar weakened and expectations for a September Federal Reserve rate increase declined. That is a very important development. Interest rates matter because gold and silver do not pay interest. When investors can earn attractive returns from cash or government bonds, the opportunity cost of owning precious metals becomes higher. But when expectations shift toward lower rates, the equation changes. Suddenly, gold becomes more attractive. Silver can benefit too, and the market is currently watching the Federal Reserve very carefully. The Federal Reserve kept its target federal funds range at 3.5% to 3.75% at the July 29th meeting. The decision was made by a 9-3 vote. 3 officials preferred a quarter-point increase. The Fed also said inflation remains elevated relative to its 2% goal. That tells us something important. The Fed is not declaring victory over inflation. At the same time, the market has become less convinced that rates will move higher. That disagreement between official policy and market expectations can create volatility. Gold often reacts quickly when traders believe monetary policy is becoming less restrictive. Silver can react even more aggressively when investors decide that monetary conditions are turning supportive. Then there is the dollar. Gold and silver are priced globally in dollars. When the dollar weakens, precious metals can become more attractive to buyers using other currencies. On August 17th, the dollar index weakened while gold gained. Reuters reported that softer economic data reduced expectations for a September rate increase. That combination helped support both metals. This is one reason Sunday matters. Sunday trading can be quiet compared with normal weekday sessions, but the market can still reprice expectations before the next major trading week begins. If traders enter Monday expecting weaker rate pressure, then precious metals can open with a very different tone, and if silver starts pushing higher while gold remains strong, the ratio could begin moving lower. That would be the signal many silver investors are watching. A falling gold to silver ratio means silver is gaining relative strength. If gold rises while silver rises faster, the ratio falls. If silver suddenly accelerates while gold remains stable, the ratio can fall quickly. That is when the market can become extremely interesting. But there is another factor that deserves attention: central banks. Gold has been supported by strong official sector demand. The World Gold Council reported that central banks added a net 41 tons to global gold reserves in May. That shows that official gold accumulation remains an important part of the market. Central banks do not normally buy gold because they are chasing a short-term chart pattern. They buy it because they think about reserves, they think about diversification, they think about currency risk, they think about financial stability, and they think about the long-term structure of the global monetary system. That matters because strong official demand can create a persistent foundation under gold prices. Silver does not have the same central bank demand structure, but silver can benefit indirectly. If gold remains expensive and investors still want exposure to precious metals, then silver can become more attractive. This is especially true for investors who believe gold has already moved too far. Silver often becomes the cheaper alternative. That does not mean silver is cheap in absolute terms. It means silver can look cheaper relative to gold. That distinction is critical. Now consider the industrial side. Silver is not simply a monetary metal, it is a critical industrial material. Modern technology needs silver because of its electrical conductivity. Solar technology uses silver, electronics use silver, power systems use silver, medical applications use silver, advanced manufacturing uses silver. As economies invest more in electrification and digital infrastructure, the strategic importance of silver can increase. This creates a completely different demand structure from gold. Gold can rise during economic fear. Silver can rise during economic recovery. But silver can also rise during monetary uncertainty. That is why silver can be extremely powerful when multiple forces align. Now imagine the following scenario. Gold remains above $4,400. The dollar stays under pressure. The market becomes increasingly confident that the Fed will eventually ease policy. Inflation remains uncomfortable, but does not force the Fed into aggressive tightening. Industrial demand for silver remains firm. Investment demand returns. And the gold-to-silver ratio begins falling from the upper 60s. That would be a very different environment from one where gold rises alone. That would suggest capital is moving deeper into the precious metals complex. And that is exactly why investors should not look at the silver price in isolation. Watch the ratio, watch gold, watch the dollar, watch Treasury yields, watch the Federal Reserve, watch physical demand, watch investment flows. These signals tell a much bigger story. Another major factor is inflation. The July U.S. Consumer Price Index showed inflation rising 3.4% year over year. The reading was viewed as manageable enough to reduce expectations for an immediate rate increase. Precious metals responded positively. Gold futures gained while silver also moved higher. But there is a subtle point here. Cooling inflation does not automatically mean precious metals should fall. Many investors assume that lower inflation is bearish for gold. That is not always true. What matters is the relationship between inflation and interest rates. If inflation cools while interest rates remain high, then real yields can remain attractive. That can pressure precious metals. But if inflation cools and the market expects the Fed to lower rates, then precious metals can benefit. The market is therefore watching the direction of policy expectations rather than one inflation number. This is why economic data has become so important. Every inflation report can move the dollar. Every employment report can change rate expectations. Every Federal Reserve statement can change Treasury yields, and every major move in yields can change the opportunity cost of holding gold and silver. Silver is particularly sensitive because it combines monetary and industrial characteristics. When the dollar weakens, silver can benefit. When rates are expected to fall, silver can benefit. When manufacturing demand strengthens, silver can benefit. When investors rotate into precious metals, silver can benefit. That is a lot of potential fuel. But investors must also understand the risk. Silver is volatile. The same leverage that can create powerful gains can create sharp declines. A ratio near 68 does not mean silver must immediately collapse toward 50. It also does not mean silver must instantly reach $100. The ratio is a relationship. It is a tool. It helps investors understand relative performance. It should not be treated as a magic prediction. This distinction is especially important because silver has already experienced enormous volatility. The metal previously traded much higher this year before falling sharply. Recent prices remain well above the 52-week low. Reuters reported silver around $65.82 on August 17th after a 1.8% daily gain. That tells us the market is already moving. The question now is whether this is the beginning of another sustained leg higher or simply a powerful recovery inside a much larger trading range. That is where technical levels become useful. Investors should watch whether silver can establish higher highs and higher lows. A strong uptrend normally produces a series of higher lows. When pullbacks become shallow and buyers step in quickly, the trend can become stronger. But if silver repeatedly fails at major resistance, then the market may need more time. Volume also matters. A breakout without strong participation can fail. A breakout supported by strong trading activity can be more convincing. The gold to silver ratio can provide another confirmation signal. If silver rises while the ratio falls, then silver is outperforming gold. If silver rises but the ratio stays high, then gold may still be leading. If the ratio rises sharply while silver falls, then investors may be moving toward gold for defensive reasons. These relationships help tell us what kind of precious metals market we are actually in. And right now, the market appears to be balancing several powerful forces. There is geopolitical uncertainty. There is monetary uncertainty. There is a changing interest rate outlook. There is central bank demand for gold. There is renewed investment demand. And there is industrial demand for silver. That combination creates an environment where sudden moves are possible. We also need to watch Treasury yields. The bond market has been a major source of pressure on precious metals this year. When long-term yields rise sharply, gold and silver can struggle, but when yields stabilize or fall, precious metals can recover. Current Treasury yields remain elevated. The Federal Reserve's July data showed the 10-year Treasury yield around the upper 4% area at the end of July. That means the battle is not over. Precious metals still have to compete with attractive yields. But if yields begin falling while the dollar weakens, then the environment can change very quickly. This is why traders are watching every piece of economic data. The next major move in silver may not begin with silver. It could begin with the dollar. It could begin with bonds. It could begin with the Fed. It could begin with a geopolitical headline. Then silver reacts. That is how these markets often work. The trigger appears somewhere else. The precious metal becomes the reaction. Now think about the psychological side of the market. When silver approaches an important round number, investors pay attention. When silver approaches $70, the market will notice. If silver pushes beyond that level, then momentum traders may become more active. If silver approaches $80, then the conversation becomes even louder. And if silver eventually approaches $100, the psychological effect could be enormous. But getting from the current price to $100 would require a very large move. That should never be presented as guaranteed. Instead, investors should ask what conditions would make such a move more plausible. A weaker dollar would help. Lower interest rate expectations would help. Strong industrial demand would help. Persistent physical tightness would help. Strong investment flows would help. A falling gold to silver ratio would help. And continued strength in gold would provide a major backdrop. The important point is that silver does not need every factor to be perfect. It needs enough factors to align. That is why this Sunday alert matters. The market does not need a dramatic headline to change. Sometimes the biggest moves begin quietly. A ratio moves from 68 to 65, then 65 to 62. Then investors notice. Momentum increases. More money enters. The ratio falls again. That is how a relative value trade can turn into a momentum trade. And once momentum takes over, silver can move much faster than people expect. But there is another possibility. The ratio could remain near the upper 60s. Gold could continue outperforming. Yields could remain elevated. The dollar could strengthen. The Fed could remain cautious. In that environment, silver could struggle to break higher. That is the bearish case. Investors should respect it. A professional market view is not about predicting one outcome. It is about understanding the conditions behind different outcomes. If the dollar strengthens sharply, then watch silver. If yields rise quickly, then watch silver. If the Fed becomes more hawkish, then watch silver. If industrial data weakens, then watch silver. Those are warning signals. On the bullish side, watch for a weaker dollar. Watch for falling yields. Watch for easier monetary policy expectations. Watch for stronger industrial demand. Watch for investment inflows. And most importantly, watch the gold to silver ratio. If gold remains strong while silver starts outperforming, then the ratio should fall. That would be one of the clearest signs that the silver story is becoming stronger. The current market already gives us an important clue. Gold remains near historically elevated levels. Silver is recovering strongly. The ratio remains near the high 60s. Central banks continue buying gold. The dollar has recently weakened, and rate hike expectations have fallen. That is not a guarantee of a silver explosion, but it is a setup worth watching. The next phase could be very different from the previous phase. Gold may remain the anchor. Silver could become the accelerator. That is the key idea investors should remember. Gold provides monetary protection. Silver provides monetary exposure plus industrial leverage. When the precious metal cycle becomes powerful, silver can sometimes move dramatically after gold has already established the trend. That is why a ratio around 68 is more than a random number. It is a signal about relative strength. It tells us that the silver story is not finished simply because silver has already rallied. The market could still be deciding where the next phase of leadership comes from. And if silver begins taking that leadership, then the ratio could fall rapidly. So as we head into the new week, keep your eyes on three things above everything else. Watch the dollar, watch interest rate expectations, and watch the gold to silver ratio. Those three indicators can tell you a great deal about what precious metals investors are thinking. If the dollar weakens and rate expectations fall while the ratio declines, then the bullish case for silver becomes much stronger. If the dollar strengthens and yields rise while the ratio climbs, then caution becomes more important. This is not about chasing a number. It is about understanding the market behind the number. And right now, the market is sending a message that deserves attention. Gold is still extremely strong. Silver is still recovering with serious momentum. The Federal Reserve remains caught between inflation risks and economic uncertainty. Central banks remain interested in gold. Investors remain focused on the dollar. And silver remains one of the most interesting metals in the entire commodity market. So if you own silver, do not just watch the silver price. Watch what silver is doing compared with gold. Watch whether the ratio starts falling. Watch whether buyers step in during pullbacks. Watch whether silver begins breaking important resistance levels. And watch whether the macro environment continues to favor precious metals. Because the biggest move may not come when everyone is talking about silver. It may come before the crowd fully understands what is happening. That is why the gold to silver ratio matters. That is why this Sunday matters. And that is why the next few trading sessions could be very important for precious metals investors. The story is not that silver is guaranteed to explode. The story is that silver has several powerful forces working around it at the same time. Gold is strong. The dollar is vulnerable to further weakness. Rate expectations are shifting. Central banks remain committed to gold. Industrial demand gives silver another source of support. And the ratio remains close enough to 68 to keep the relative value question alive. If silver starts outperforming gold from here, then that ratio could become one of the most important charts in the precious metals market. And if that happens, the market may look very different by the time everyone notices. This is exactly why you should stay focused on the data rather than the headlines. Do not assume every rally is permanent. Do not assume every pullback is the end. Watch the trend, watch the macro signals, watch the ratio, and stay disciplined. If you found this analysis useful, then make sure you like this video and subscribe to Silver and Gold Watch. Turn on notifications so you do not miss the next major gold and silver update. And tell me in the comments where you think the gold to silver ratio goes next. Do you think it falls below 65, or do you think gold continues to dominate? I want to know what you think. The precious metals market is moving fast. Gold is sending signals. Silver is sending signals. And the ratio may be telling us that the next chapter has already started. Stay alert, stay informed, and keep watching the metals.